5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. Today's episode number 507, entitled Empire of Debt. So again, my name is Jerry Robinson, as you just heard, founder here at followthemoney.com. We've been doing this podcast now since 2010, one of the longest running personal finance podcast. It's great to be here with you today. Today's show is really an important one. It's kind of ironic too. I'm recording it today on tax day. It's April the 15th, 2026. And today we're going to be looking, basically taking a hard look at the U.S. national debt, which is now closing in on $40 trillion. You might have heard recently it passed the $39 trillion mark. I'm going to walk you through what's really happening beneath the surface and why it continues to grow regardless of who's in power and what it means for the future of the U.S. economy. We're going to tackle that in segment one. In segment two, I'm going to share my latest market insights. We're going to look at the S&P 500, the Nasdaq, gold, silver, Bitcoin, crude oil, the dollar. I'll give you my current read on where things might be heading next. We've seen a pretty big rebound in the markets over the last several sessions. Then we'll wrap things up with a final word. As always, thanks for joining me. Now let's get started. All right, friends. Well, let's talk about it. Today we are talking about something that really should honestly stop every single American in their tracks, but somehow it just doesn't seem to register with us. The United States national debt now above $39 trillion, closing in on $40 trillion. And that's just, that's just where we are. That's the truth. We're not slowing down. We're accelerating when it comes to taking on new debt. If you look at the latest figures, we're adding debt at a pace that it almost makes the numbers meaningless. It just keeps getting higher and higher day after day, trillion after trillion. I think part of the problem is that most people can't really understand what $1 trillion actually represents, right? Let alone $39 trillion. Let's bring it down to earth. That's about $350,000 per U.S. taxpayer, right? That's about $113,000 for every man, woman, and child in the United States. And while that sounds big, it actually doesn't even tell the full story, because when you hear $39 trillion or $40 trillion, you're only hearing about the official debt. That number does not include the massive unfunded liabilities that are sitting off of the books, like Social Security and Medicare and government pensions. When you start to factor all of those in, you're not even talking about tens of trillions of dollars anymore. You're talking about hundreds of trillions of dollars, right? We're talking about numbers so large that they barely even register. Now, I want to zoom out for a moment because the context for all of this really matters. Back in 2007, when I was writing my book, Bankruptcy of Our Nation, the total U.S. debt, the total national debt back then was around $9 trillion. $9 trillion, right? Today, we are at, what did I say, $39 trillion, almost $40 trillion. So that's been more than a 350% increase in less than 2 decades, right? 350% increase in our national debt. Now compare that to the growth of the actual U.S. economy. Over that same period, the U.S. GDP has grown just a little over 100%. So what does that tell you? Well, it tells you that debt here in the United States, especially at the government level, is growing roughly 3 to 4 times faster than the economy that's supposed to be supporting it. Now, that obviously is what we would call unsustainable. It's never been sustainable, and yet here we are. Now, whenever we bring up this topic, people immediately want to make it political. They'll say, well, it was this president or it was that party. But when you actually look at the numbers, it becomes very clear that this debt problem that we have in the United States is completely a bipartisan issue. Go back to President Obama, who oversaw the addition of more than $9 trillion to the national debt over his 8 years in office, his 2 terms. Then President Trump added nearly $8 trillion in his first term, with some of the fastest annual increases ever witnessed here in the United States. Then President Biden came in, and he added another $7 trillion plus in just 4 years. And now we're seeing the same pattern continue in Trump's second term. It does not matter who is in office. The trajectory doesn't change. The promises may change. The speeches certainly change. The slogans may change. But the debt keeps rising. And I think it's important to understand that because it tells you that this is not a leadership problem alone. This is a system problem, right? It's a systemic issue that we're facing here in the United States. Now, let's talk about what I believe is probably the most dangerous part of the whole thing. Not the debt itself, but the cost of carrying the debt. Right now, the United States government is spending, I hope you're sitting down, right now, the United States government is spending roughly $88 billion per month on interest payments. Right? That's insane. That's over $1 trillion per year just to service the existing debt that we have. We're not paying it down. We're not reducing the debt. We're simply trying to service and pay the interest on the money that we've already borrowed while continuing to borrow even more. And we just got the latest numbers showing the overall spending, the outlays, the receipts from the federal government. And what we see when we look at it is that those interest payments are now one of the fastest growing parts of the federal budget. In fact, they're on track to become the largest expense over the next few years. Some estimates suggest that over the next decade, the United States could spend $13 trillion just on interest. That means you don't get any new roads, no new schools, no shoring up Social Security or Medicare, just interest. At some point, we have to step back and ask ourselves a very simple question, and that is, how long can this continue? How long? It's completely unsustainable. Now, let's layer in something else on top of all of this, and that's war spending. We're already seeing reports suggesting that the existing war with Iran that the United States is waging could cost as much as $1 trillion over time, right? $1 trillion. In the first few days alone, the Pentagon was already burning through billions. And at the same time, we're looking at military spending proposals recently put out by the Trump administration, calling for a $1.5 trillion Pentagon budget for next year. This, by the way, is an institution that can't even pass an audit, and they want $1.5 trillion. That's higher than anything we ever saw during World War II, even when adjusted for today's, dollars based on inflation. But this is what empires do, right? They expand, they defend, they project power. They spend heavily to maintain that position, of course. But history shows us that there's always a cost, right? Empires certainly don't collapse overnight. They stretch themselves financially, and then eventually something breaks. Now, to be fair, this isn't just a U.S. issue. Global government debt is now around $111 trillion, right? So we're living in a world that is awash in debt, literally built on debt. But the United States sits at the very center of that system, with the dollar still the world reserve currency. And that gives the U.S., of course, this unique advantage, which allows us to borrow more for longer than most countries ever could. And that, of course, creates that dangerous temptation, because when you can print the world's reserve currency, the pressure to remain disciplined suddenly just disappears. And that brings us, of course, to the topic of inflation. That's a topic we really don't always connect directly to the debt, but it's something that we all feel. Over 40% of all U.S. dollars ever created were printed in just a short window between 2020 and 2022. So you don't have to be an economist to understand what that means. You have more dollars chasing the same goods, prices are rising, purchasing power is falling. So while we're not currently defaulting on our debt in the traditional sense, we're doing something else. We're slowly reducing the value of the currency used to repay it. So basically, it's a quieter form of default. It's very real. But it's a very real form of default. Let's look at the current fiscal picture, for example. In the first 6 months of the fiscal year of 2026, the federal government brought in around $2.5 trillion in revenues, right? They call that receipts. And then it spent roughly $3.7 trillion in outlays. So that's a deficit of around $1.2 trillion in the first 6 months of fiscal year 2026. Now, if that pace continues, then we're looking at another massive annual deficit, and I expect it to continue based upon the current trajectory of the spending at the federal government level. So that's going to be added. That annual deficit of probably $2 trillion now by the end of the year is going to be added on top of an already massive debt. Now, I like to keep things simple, so let's just assume that we're talking about a household. We'll keep these big numbers instead of trying to change them. I don't want to confuse us, but imagine bringing in $2.5 trillion and then spending $3.7 trillion in the first 6 months. There would not be a debate about that. You wouldn't have to call a committee together. There wouldn't be a press conference. What this would be called is simple. It's called bankruptcy, right? Now, something else is beginning to quietly shift in the background as well, and that is global confidence. I got recent surveys here right in front of me, which are pretty mind-blowing, coming to us from Gallup that show that approval of U.S. leadership around the world has been declining big time, right? At the same time, countries like China are gaining influence. I'm looking here that says China surpassed the United States in global approval ratings in 2025, with a median of 36% approving of China's leadership compared with 31% for the U.S. China's 5 percentage point advantage over the U.S. is the widest Gallup has recorded in China's favor in nearly 20 years. And that's a topic I've been talking about for a very long time, about the rise of China and, of course, the decline of the American West, right? We're seeing it right before our eyes, and debt has a lot to do with it all. And then we're also seeing some other things like nations repatriating their gold reserves. France, for example, just recently brought home all of its remaining gold from the New York Fed. This is a big deal. I mean, for years, right, European nations were content to let us hold their gold, and that gave us, of course, an advantage. Well, we're seeing a slow erosion of trust here in the United States. And when that trust begins to erode in a system that is built entirely upon debt, then things can change pretty quickly. Now, I want to bring this back to something more personal because it's easy to point the finger at Washington and say, well, they're the problem. And in many ways they are. But there's also a mirror here, right? As a nation, we have become comfortable with debt. Americans rely heavily upon credit cards and auto loans and student loans and home loans and all of these different loans. Living beyond our means has become normal. And in many ways, Washington simply reflects the behavior of the people. And while we may not be able to change what's happening in Congress, we can certainly change what's happening in our own lives. We don't have any control necessarily how the congressmen are actually going to do their job. You can vote for someone who says something, but you can't control what they do when they get in. But you do control your own decisions, right? You have control over that. We can change what's happening in our own lives. We can reduce debt in our own homes, in our own households. We can build margin. We can prepare. Because at the end of the day, we'll find out that we are ultimately responsible for what we control. We don't control everything, but the things that we do control, we need to exercise control over, especially with our finances. We've been talking about that here, of course, on this broadcast for years. But here's the important part I wanted you to take away, is that empires don't usually fall all of a sudden. They don't fall all at once. This is something we've been talking about for years, that in many ways, many people have expected the United States empire just to go poof overnight. And and I talked about it in my book, I've talked about it for years, that's not how empires end, right? Typically, you have a very slow erosion of trust, a slow erosion of confidence, and that's exactly what we're seeing play out here in the United States. We're seeing the United States government and its influence in the world weaken slowly over time, often in ways that people want to ignore until one day the consequences simply can't be ignored anymore. Now, the question isn't whether this trend is going to continue. I'm telling you that that's what we're seeing. It is definitely continuing this way. We are on an unsustainable track. The question is whether you're paying attention and whether you're prepared. And in that regard, I want to give you two resources here before we close out and move into segment two, because I want to get into what all this means for the markets right now and where the opportunities might be hiding. But, there's two things I would suggest to you right here. We have two excellent resources for you on our website that are entirely free. The first one has to do with debt. If you're struggling with debt out there, you're hearing all these crazy numbers about the government, and you're thinking, well, I've got some crazy numbers too, in my own household. Well, you can change that. You can't change the White House, but you can change your house, right? And that's where all this needs to begin. So the first resource I would recommend to you is our very cool debt stacking method that allows you to pay off debt very quickly. It doesn't require any kind of debt consolidation. It doesn't require you to call anybody. All you're going to do is you're going to focus on how you pay your debt. You're going to structure it differently, and you can do it yourself. Go to followthemoney.com/debt. There you'll get all the resources. It's all free. We have a podcast there. We have a PDF download, cool example and everything there. So if you're struggling with debt, it's a problem in your home, take every opportunity you can to really seize the day here and challenge it. Let's make 2026 the year that you break free or have a plan to break free from that debt. So that's followthemoney.com/debt. We also have our 5 levels of financial freedom, which is going to show you how to get from A to B, how you can actually manage to break free financially. You can get all that information at followthemoney.com/5 levels. And on an upcoming podcast episode, I'm going to be covering our 3-bucket strategy. It's a financial strategy that really gives you a lot of guidance on how to clarify your finances. Be watching for that upcoming episode because we got a brand new report that's going to be coming out with it as well. So be looking for that. But those are my suggestions to you in this current environment. We have a out of control government spending money like a drunken sailor, and all you can do is protect yourself. All you can do is insulate yourself and your family and your community. But there's not much you can do about these congressmen who are beholden to special interests. There's not much we can do except vote them all out. But I don't think America seems to really want to do that. We keep voting the same stooges in over and over and over, and we keep getting the same result. So all you can do is work on your own situation. And I encourage you to do that. We create resources here for you to take control of your finances. All right, so as I mentioned, when we come back, we're going to look at what all this means for the markets right now. We're going to look at all the major markets, and we'll talk about where those opportunities might be hiding. Stay with me. We'll be right back. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the program. All right, so let's talk about the markets because that's what I want to focus on right now. The markets have been through some wild stuff over the last several weeks, of course. We saw the markets hit those fresh highs. the S&P 500 at the beginning of the year. Then we began to take a dive down in the month of March amid all of the tumult with the U.S. and Israel war against Iran. But over the last several sessions, probably the last couple of weeks, we've seen a very strong rebound. The S&P 500 going from around 6,350 or so, actually a little lower, all the way up to where we are now as I record this at nearly 7,000. We're closing in on a brand new record high, at least intraday. We'll see if the market closes at that fresh high by the end of the day. We know how volatile the market's been. There could be an announcement and the market comes down again before the market closes. But as it stands right now, we're seeing a very strong rally in the market. Right now, we have the S&P 500 back above its 200-day moving average, back above its 50-day moving average, and it held that really important demand zone between 6,150 and 6,500, pulled back into that area, got a bid, pushed right back up. Now we're looking at maybe a brand new record high right on the way. We've seen a very strong move over the last 3 weeks. The last 3 weeks, including this week, have been up. So about 2.5 weeks, I guess, is what we could say. We also bounced off of that 50 weekly moving average. If you watch the weekly chart, very important number there. We're also, if you look at the percentage of stocks in the S&P 500 that are trading above their 200-day moving average, a very important market breadth metric that we like to follow, that's back in bullish territory. It's about 56, 57% of stocks back above their 200-day moving average in that very important index. The Nasdaq 100 looks similar. If you look at the Nasdaq 100, I'm looking at QQQ, and I'm seeing this very similar shape of the overall market. We topped out, in late January, early February, and then we began. Actually, the all-time high was hit back in late October. We got up to those same areas in January, but as far as for the year goes, that was our peak. Then we came down on QQQ to around 555 or so. We've seen QQQ then rally, and now it's sitting at about 630 or so as I record this. So we've had a very strong recovery. We've gained back all of the losses that were experienced over the last several weeks. It kind of reminds you of what we talked about last time on this broadcast. The name of last podcast episode we did, episode number 506, if you missed it, go back. It's called Stay the Course. And what I was encouraging you to do in that episode was to not let, all the headlines cause you to lose your cool, but to actually try to take advantage of what was going on with the fear in the market. And sure enough, the market seemed to be turning around. We're even seeing that in tech, obviously, as the Nasdaq 100 rebounds. Again, another really strong rebound from the 50 weekly moving average on the Nasdaq as it sits above its 200-day moving average and its 50-day moving average, closing in on a fresh record high. We also have gold. I want to talk about gold because gold has been fairly interesting in this environment where gold also slipped on the war. It was peaking out around 5,500, as you well know, 5,600, somewhere in there back in late January. And then, of course, it crashed almost down to 4,000 by late March. Now we're back up at around 4,800 or so as we speak. Gold is down slightly today, but over the last few weeks, we've seen some really strong price action. We came down and almost touched the 200-day moving average in late March, but we've since rebounded. We have some resistance overhead for gold. So on gold, there's two major areas we're watching, and they really kind of coincide. They're actually going to, they're not entirely coinciding, but they're very close. The first one is at 4,900. That's where that declining 50-day moving average is on gold. And then we have really key psychological resistance at the 5,000 level. So if we can get a 5 handle on gold, get back above the 5,000 level, that's going to really bode well for gold. There'll still be some overhead resistance there, up 5,400, 5,300, right in there. But overall, that will be a really good sign for a recovery in gold. So that's what we're watching as well. Now, let's also talk about the U.S. dollar, because the U.S. dollar did something very interesting as well this year. This year, the dollar has really been a roller coaster. It began the year at about 99.50 or so. Well, probably let's just call it about 98, 99, somewhere in there. It then fell in January as the gold was touching its high. The dollar index fell to about 95.50 or so. Then on the Iran war, the U.S. war against Iran, it rallied up to the 100 level, 150 or so, 100.50, and then it pulled back as of late, as we've seen this rally. Of course, the dollar, when it comes down, it takes pressure off of assets that are denominated in dollars. When it goes up, it puts pressure on those assets. So we saw a rising dollar, and we saw commensurately declining gold and declining markets, declining equities. And then over the last 2.5, 3 weeks, we've seen the dollar pulling back from its recent peak of around 100.50, right? And we've seen it come back down. Now it's back below the 200-day. It's back below the 50-day. And so dollar coming back to where we figured it might go. And that's taking pressure off of stocks. We still have tremendous support on the U.S. dollar index at around 95, 95.50, somewhere in there, even up to 96. I suggest to you that we're going to break down below that area, and that's going to, over the coming weeks and months, and that's going to help turbocharge the rally across various, classes, equities, commodities, and things like that. I expect the dollar to weaken here, sooner rather than later. And then let's also talk briefly about China, because we like to track China through a few different ETFs. You can use FXI. One of the ones that's low volume but extremely useful for tracking the Chinese market, Chinese equity market, is the SPDR S&P China ETF GXC. I don't like to use it for investing or trading because it's so low volume, but it really is a helpful metric for tracking nearly 1,200 of the most important and liquid publicly traded Chinese equities. And right now, it's trading below its 200-day moving average, but it is rebounding right now. So we are seeing Chinese stocks on the mend. We also have silver. Silver is also looking very interesting here. Silver, of course, the price action's been really zany. One of the most important metrics we watch on the physical silver market on a chart is the 30 SMA. That's the 30 simple moving average on a daily chart. That area has been serving as resistance now ever since we slipped below it back in late January, early February, right after we touched that fresh peak on silver at an all-time high on the 120s. Well, we've been struggling around that 30 SMA. We just now got back above it in a meaningful way in yesterday's price action when we got up to around $80. We're still sitting right around that level now as we see silver holding on right around $80. Silver also has that same potential as gold to begin to move back higher. And that's what we've been seeing now. We've seen 1, 2, 3, 4 weeks now of gains in silver coming off of that nearly $60 low that was hit back in mid-March. So we're seeing a nice improvement there in the price action of silver. Oil prices, also very interesting because they have gone, if you go back before the war, the price of West Texas Intermediate U.S. crude oil here in the United States was trading below $70. It was like $65 or so pretty much throughout the whole entirety of the month of February until we got to the end. And then we saw oil, of course, go nuts. It went all the way up to around $120. Brent crude did the same. But we've seen now oil come back down to earth. It's back. It's not quite back to where it was back in February at 65, but it's down to about 92. And it got as low as $87 earlier in today's trading session. So we're definitely seeing it ease. And we would expect oil to continue to ease if we have those expectations of a ceasefire between the United States and Iran. But it doesn't mean that we should expect oil to come straight down. And I would also suggest to you that these elevated oil prices have already done some damage in terms of affecting prices for everything. I mean, oil is an input price for practically everything on earth, right? Whether it's oil composes the product or whether it's used to transport the product once it's created, all the goods on earth are very dependent upon oil. And so So with them being elevated, you're going to expect to see that translating and kind of flowing out into prices, into the general price levels. And I would expect that to continue. And I'd also expect energy companies to still thrive with current prices. So I don't expect energy stocks necessarily to crash. They've been leading something fierce since the beginning of the year. The whole, XLE, the S&P energy sector, has just really been the big leader this year in terms of gains. So energy still holding well above where it's been, naturally for the last, few years, but it's beginning to come down a little bit to give us some relief. Gas prices still a bit more stubborn. They're not coming down as quickly, but nonetheless, natural gas, by the way, completely depressed right now, really down hard, and it's actually at its lowest level of the year right now as we speak. You'd have to go all the way back to maybe last year, maybe last summer, to see prices near where they are today. So we certainly have that going on. Let's also talk about the state of Bitcoin and Ether. So since the war began, we've seen pretty big gains in Bitcoin. Bitcoin right now trading at about 74,000 as we speak. And Bitcoin, of course, is the world's largest digital asset, but it's one that we've been talking about here on this broadcast for more than 12 years. It's hard to believe, but Bitcoin, we think, has a lot of potential upside still, along with ETH. We'll talk about ETH in just a second. Bitcoin has a lot of overhead resistance right now. It's going to take some time to work through it all. You've got some really heavy resistance at that declining 200-day moving average, which is currently at around the 87,000 level or so, and we're still trading at about the 74,000 level. The really key support level we continue to watch on Bitcoin is that 200 weekly moving average, which we have not touched, and it's currently around 60,000. So we could see Bitcoin coming down to 60. I've even suggested to our members we could even see it come down to 50,000 before it really begins to turn around. But nonetheless, those are the key areas we're watching there on Bitcoin. Let's also talk real quickly about Ether, or as people know, Ethereum, the Ethereum network. Ether is currently moving up into a key area where it often gets bat down in price. We've been up in this level a couple of times this year since we lost a lot of the elevated price levels that were experienced last summer. We were up like $5,000 on Ether last summer. Now we're all the way back down. We've been cut in half, basically. But we came all the way down to $1,750 on Ether. And then we've seen that become the low early February. And since that time, we've seen it rise pretty nicely. And we're now sitting at about 2,300 on ETH. The same thing is with Bitcoin. That declining 200-day moving average is going to be a bear to get past. That's currently around 2,900. So there's plenty of, room for ETH to go up, but there's going to be a lot of, overhead resistance all along the way. So keep that in mind if you're investing in the crypto space as we are. We just did, by the way, our brand new Q2 2026 DCA investing strategy for all of our members. We did a big video on it. What I do is I dollar cost average across my favorite stocks, ETFs, and cryptos every single Friday. And then we alert all of our members via our weekend report, via our private Twitter feed, or I guess X feed now, also by email, as soon as we dollar cost average. And so as soon as we invest, we let our members know, and we tell them what we're buying, we tell them when we bought it, the whole 9 yards. That's for our long-term investment portfolio. So we just did a big Q2 update, though, to explain what we were going to be watching in Q2 and what we were going to be really focusing upon with our dollar cost average dollars. So I encourage you, if you're not currently a member and you want access to our market insights, we're constantly providing them. Daily trading ideas put out to our members. We have tons of resources on our website for our members as well. And then, of course, we share with you how we're investing, what we're buying, when we're buying it, all of those things, what things we're thinking about buying, all of that in advance. So I encourage you to check it out. If you're not currently a member, you go to followthemoney.com/join. Or maybe you just need advice. Maybe you need somebody to talk to about your overall finances. We have a advisor network here. We can put you in touch with one of our advisors who gets it, who understands how the economy works and can help you create a plan for retirement or just get a better handle on your finances. If you need help there, reach out to us. followthemoney.com/advice. Fill out that brief form. We'll put someone in touch with you very, very shortly, usually 2 to 3 days. All right, well, on the other side of this break, we're going to come back with our concluding thoughts and a final word. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. And we've covered a lot today. We talked about a national debt that's pushing $40 trillion. And we talked about the interest payments that are now exceeding $1 trillion a year. We talked about deficits that continue no matter who's in power. We talked about the bigger picture and what this means for the country and for the dollar and for the future. And I want to leave you with something perhaps a bit more simple. Because at the end of the day, all of these big numbers, these government reports, these charts and headlines, they can all feel abstract. But the reality is not abstract. It shows up in your daily life. It shows up slowly, but then all at once. It shows up in the cost of groceries. It shows up in the cost of housing and rent. It shows up in your auto payment and your student loan payment. It shows up in the quiet erosion of purchasing power over time. And most people never connect it back to the source. They don't see the link between debt and the currency that they use in their everyday life. But the connection is there. It's been understood for a long time. The famed economist John Maynard Keynes once wrote it this way. He said, "There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency." And that, friends, is what we have seen play out again and again throughout history as governments accumulate debt, and then the pressure begins to build, and then eventually something breaks. Sometimes the governments have to impose austerity. Sometimes they simply default. But more often, it's inflation. Another famed economist, Milton Friedman, put it plainly when he said inflation is taxation without legislation, right? So no vote, no bill, no debate, just a slow, steady transfer of purchasing power away from savers and toward the system. And that's why all this matters, because many people are focused upon the surface, but the real story is happening underneath. You can feel it, even if you can't always explain it. And I'll say this as clearly as I can. We are not managing the debt. The debt is managing us in this country. Every year, more resources are diverted just to keep this bloated system running. Every year, we have less flexibility, less room to maneuver, less margin for error. And that's not a direction that is going to lead this country to strength. It is a direction that leads this country to fragility. And I don't say that to be an alarmist. I say that because it's reality. And if you understand reality, you can respond to it. You can better prepare for it. You can make better decisions. You can avoid being caught off guard. Because the truth is, the system works until it doesn't. It's like that game of musical chairs. Eventually, it comes to an end. And when it changes, you're not going to get an invitation, right? It's just going to change. So you got to stay aware. You got to stay disciplined. And above all, you need to stay prepared. Because in a world built on debt, clarity and preparation become your greatest advantages. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Till then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.